So today we're going to dive into offshore oil and why I continue to be bullish even though short-term price action has been bearish, and if it keeps falling, why I think it's going to be a buying opportunity. But the caveat to that is that one must know that in a recession, if that's what you're thinking, that oil does not do well and that offshore oil trades like death. And it would be nothing to easily have a down 50 to down 75% from where we're at. And that might only last a couple of quarters, but you have to keep that in your time frame, have the cash on your balance sheet to act on it when it happens, and to have your short-term, mid-term, and long-term action plans all aligned with different scopes and understandings of what to do. So here's a chart of oil, and that does not look good at all. That does not look bullish. That does not look good at all. And as I've discussed before in videos, flip the chart upside down and then see how you think about it. And to me, this looks like a very bullish chart. Matter of fact, it looks like it broke out and then retested the prior high and is now bouncing off of that, which means that oil would be going lower. Now, if you're basing everything you're doing in your positions on a long-term time horizon off of a single point of analysis of a chart, then, well, good luck with that. That's not my strategy, but it's worth keeping in mind. So, offshore oil, that's where I'm focused. That's all I really care about. So, you have to know where you were and know where you're at to know where you're going. And currently, between Transocean, Valaris, Noble Corp, Seadrill, and Diamond Offshore, in which I have a position in Tidewater in Transocean, and Tidewater isn't an offshore driller, but it's tangentially associated with the industry. You have to see the consolidation that's happened in the industry. The top 5 players control almost 70% of currently operating floaters. And currently we're sitting at a market cap of $12 billion. The pre-consolidation peak that happened back in, I believe, 2014-ish era, 2012, 2014, had a market cap of $89 billion among all the players. And an enterprise value of $163 billion versus today's $19 billion. So that's roughly a 7 to 8x that needs to occur to get back to where we were. Now, I see a lot of these fallacious arguments about looking at Transocean's chart and how it might reach an all-time high, but you have to factor in that particular case, not as an industry sector whole, share dilution that's occurred. But Valaris, for instance, came from Insco and Atwood Oceanics, and then Insco and Rowan gave the baby known as Valaris. And as we discussed in the video not long ago, Valaris got put into the S&P 400 mid-cap or one of those ETFs. So that should help see some fund flows. And then Noble Corp was a combination of Noble Corp, Pacific Drilling, and I can't remember how to pronounce that, so I'm not even going to try. And then Diamond, still Diamond, and Transocean managed to pick up some players along the troughing period. And so that all indicates to me that they have better pricing power. There's not an oligopoly, and things are heading in the right direction. Even though WTI's or Brent's retraced from its pump in last March from a year ago at this point, and other variables. So the short to midterm time horizon might be bearish, but then that's when you should be educating yourself and positioning yourself to be able to take advantage of opportunities. So back in 2004, compared to 2022, we're sitting at the same number of floaters. And you see this in a lot of bull markets. For instance, nuclear. You go from having 10 or 15, just a handful of uranium miners, to 500 listed uranium miners. And then when it's all said and done and everything becomes washed out, you're back to 10 or 15 uranium miners. And the cumulative orders between 2004 and 2014 for floaters was 184. And from 2014 to 2022, there's been 181 floaters scrapped, which means that we're, well, sitting about the same number of floaters. And new efficiencies have developed in the Gen 8 rigs that Transocean has, and so on and so forth, that makes it where we don't need as many floaters as we once did to produce the same amount of oil. So that's not to, so that's to say that we might not get to the same numbers that we were at once upon a time. So you have to factor that in. If they're 20% more efficient, then, well, an equivalent of 184 at 20% more efficient would, I don't know, be around 150-ish somewhere, give or take 10 floaters. So you have to factor these things in. Right now, even though Transocean says, and we'll get to that, they're around, the average day rate is around 355,000, but this chart's saying 400,000. So the current day rates imply high single-digit RONB. That's replacement only, no buy. And then we'd have to get up around the 700,000 to 800,000 day rates, likely needed in order to stimulate new builds, to make it cost-effective and practical. And then beyond that are lofty idealizations that are probably years into the future. But it's always worth, knowing the upside of your thesis. So right now we're sitting good, and this all matters because one of the things that often happens is in cyclical industries is you get overinvestment, which leads to overcapacity, which then leads to compressed margins and collapsed earnings. And at some point, this will play out once again. But I don't believe we're there yet. To get a bit more fancy and detailed, recent leading edge floater fixtures have been inked between 400 to 450,000 day rates. This is from Clarkson's Research Services. And the ultra deep water floaters average day rates is what you see in the chart. And I'll just read the observation. The cyclicality of the offshore drilling industry is evident. After printing day rates in the sub 200,000 day range for approximately 5 years between 2016 and 2021, leading edge rates for UDW's capacity have now accelerated above $400,000 a day, with some clean fixtures as high as $450,000. While there was a discrepancy between floater utilization and rates after the 2018 rate trough, at least for marketed utilization, the gap is starting to close. In other words, utilizations shot up, and it's only now that the day rates are following suit. While marketed utilization was in the low 70s during the COVID downturn for benign UDW capacity, this number is now over 95%, with almost all assets having some sort of forward commitment. The increase in utilization has come at a time during which several stacked assets have been reintroduced into the warm fleet. We think the current limited difference between the marketed fleet and the competitive full fleet, including the remaining stacked assets and new builds, partially explains why the rate versus utilization gap has narrowed. In other words, there's not enough rigs to satisfy demand, and or we're getting at an inflection in which the market is saturated with available rigs, so now the lower tier non-preferred rigs that are cold stacked are going to have to come to market. Now, that one was for floaters. Jackups, which are seeing Saudi Arabia with their multi-billion-dollar build-out, is going to be a lot of jackups. And you're seeing it here too. The global average benign jackup rate was below $200,000 a day from 2015 to 2022, almost 7 years. While individual fixtures have been both higher and lower during the period, an average is usually a good proxy to explain the movement of the broader market. That is why breaking above the $100,000 day in late 2022 was an important milestone, as the chart demonstrates. And yet again, the day rates are catching up with the utilization rates. And the reason that isn't because of some magic. It's because contracts are rolling off and new contracts are being signed. And in that, more money is being made because of the supply-demand imbalance. So on the right side, you'll see the floater order book and order book as a percentage of the fleet. And what you see is the order book as a percentage of the total fleet has been, well, precipitously falling from 2008 to 2012, and then another nice tranche between 2014 down to 2019, and kind of started going back up, and now it's dropped back off. But the point of this is the order book. So really you care about day rates, you care about utilization rates, and you care about backlogs, and you care about the order book as a percentage of total fleet. Because that means that new rigs are going to come to market, and yet again, it's basic supply, demand, commodity 101 economics. If there's more demand than there is supply, i.e. more rigs, then they have less negotiating power. And since it's a very, even though there's a handful of players, they'll still defect as quickly as possible and try to get their best price, even if it means undercutting the market and ultimately hurting themselves. But that's how these things go. At some point, the order book as a percentage of total fleets is going to jack up, as you saw between 2005 and 2008. That's going to happen. That's going to be a sign to start getting out of the market. But that hasn't happened yet. So far, so good. All of this is good news. All of this is good news. Now, offshore CapEx expected to grow 17% in 2023. Now, that shouldn't be too alarming for anyone. That's actually a healthy sign. It means demand's there, and it means that people are feeling comfortable enough, companies are feeling comfortable enough to invest in CapEx. And so you're going to see a reinvestment cycle, and at first that's okay. That's actually just more revenue, more earnings, and so on and so forth. And I mean, that's positive. So a couple of terms is FID, which is final investment decision. If we go back to this chart on the left-hand side, you see pre-2023 FIDs, so on and so forth. Final investment decision. That's the board of directors and everyone sitting down and saying, okay, what are we going to do? How much are we going to spend? What kind of returns can we think we're going to get from it? So the final investment decisions, until there's a final investment decision, it's all hearsay. You don't know. You can speculate, but the final investment decision lets you know what is actually going to happen. And as you see, it's dropped precipitously from 2014 and then kind of troughed out in 2020, and then it's slowly and incrementally building back up. At least that's the projection. That's another healthy sign. So Transocean. At the bottom of the screen, you see estimated average contracting day rates. And for Q1 of 2023, it's $348,000. Q2 of 2023, it's $355,000. For Q3 of 2022, it was $329,000, and Q4 was $332,000. What you see is incremental improvement. My preference is not to see radical moves. I like a good, healthy, slow, incremental transition period. Now, of course, there's opportunities to take advantage of volatility in markets and capitalize on it if there's a big sell-off. But the fundamentals, not what's happening on a stock ticker in some QSIP, but the actual fundamentals of the industry are looking positive and not looking concerning. Now, the other thing I wanted to bring to your attention is the stacked rigs. And they have a few of them. I believe, let's see, 1, 2, 3, 4, 5, 6, 7, 8, 9 of them. And this is a chart, by the way, that's 9 months old, or 8 months old, so take that into consideration. But the rigs have been stacked, and we'll just run through them right quick. Stacked May 2016, March 2017, September 2016, April 16, February 16, July 20, February 18, April 16, June 19, November 20. Some of these rigs have been stacked for over half a decade. And So you then have to ask, what's going to be the reactivation cost of that? And who's going to pay for that? Now, the way that Transocean has speaked on their earnings calls is that they're going to make the customer pay for much of that, which is good for numerous reasons. All the incentives are lining up in the right place. Now, I believe Transocean has never reactivated a rig once it got stacked. I could be mistaken on that, but it's more the exception than the rule if that is the case. So we'll see what happens with this. Do they get scrapped? Do they get reactivated? Do they just keep them at bay because cumulatively, and by the way, once you take it out of cold stack, it's not like it just comes back into market the next day. I mean, for a company to say, let's take your cold stack or your rig out of cold stack, reactivate it with a 12-month time lag, and I'm willing to put up much of the money, is a very positive note. And that's already happening with Valaris and other players. So that's, yet again, a very positive note for the industry. And that's really all I have on the oil space for this week. And I'm going to start putting this at the end of the slides instead of at the beginning of the slides, because I suspect it deters people from watching. And it's just not a good introduction, I believe, for new audience members. Is that I sold my bank stock, made a profit on that. I turned that profit into buying a share of Tidewater and pocketed the rest on the balance sheet. And uranium still looking ugly. Wouldn't be surprised if that falls 20 or 30%. Transocean stock is not at the lows, but it's not looking the best. And honestly, Kinross is holding up rather decently with all the bank drama going on. And that's where I'm at with things. I'm still bullish on these sectors, on these industries. And if anything, you need to capitalize on short-term opportunity. I believe Transocean is down 25% from its highs. Valaris is down 25-ish% from its high. I mean, the sector as a whole is down at this moment 25%. I mean, it's a intra-cycle retracement. And I'm not saying it can't get worse. If there is no recession and everything levels out well enough with the banks, these things still might fall 10 or 20%. And at some point, and it's not at this point, I'll add to my position. And until then, I'll sit on the sidelines, and I might add more to Kinross because I was actually hoping to add to it. Well, I was going to add to it more, but I wanted that to be in the down direction and not the up. And it's still a reasonable price here. And really, below 5. I'm not buying above 5. Really, 3 and the 2 is where I want to buy it, and the 1s, of course. But really, just initiating a position in the 3s or lower is the way to go. But the low 4s isn't too bad either. If you didn't see it with, talk about these gambling precious metal stocks, the First Majestic, they shut down a quarry that I don't know why they bought it. Its all-in sustaining cost is above market cost. Anyway, they shut it down, and the stock dropped like 25% in 2 days, and now it's back up 18% off of its lows or something. Ticker symbol AG. And I thought about initiating a position there, but honestly, I'd rather just hold my Kinross and do well enough with that, I believe. So with that out of the way, thank you for watching, and until next week.